Thanks for doing this, Carl.
Always. Hey, Vetavia community, thank you for having me. It is Helmer this week here with your mortgage market update, talking to you guys about what's going on with the mortgage market and rates. Joined this week on April 19th, 2023 with our guest, James Mercado. James, please take a minute and tell everybody a little bit about yourself.
Hello, I'm James Mercado. I'm the president and CEO of a company called Provisor. Been with Vetted VA since almost the beginning. Do lots of veteran loans. Been in the business 25 years, and I'm excited to be here and bring some really valuable information today for everybody.
Awesome. Well, thank you for joining us. And y'all, if you're watching live, please go ahead and let us know that you're here. If you've got any questions, of course, we want to hear them. If you've got any comments, keep them appropriate, but we want to hear those too. And if you're watching on the replay, I know many of you do watch on the replay, go ahead and give us a hashtag replay. Let us know that you were here. Let us know that you did watch the conversation. And if you have any questions, put them in the Facebook posts. We do monitor them. Please feel free to tag James or myself, and we will take a look at those. So with all of that part said and kind of where we're at, let's go ahead and let's talk rates. Remember, this is not an offer to lend. And when we talk rates, we're talking about averages and generalities for your unique situation. You can always ask questions in the Vetted VA community. We are here as a resource with no dog in the fight or in the race, because I don't know if it's allowed to have dogs fight anymore. That's a bad thing. So, but anyway, you should always shop around for your rate. But we're here to kind of give you an idea of what you're seeing and what we're seeing and give some clarity to it. So what we said last week, well, let me start off there. Last week, James, I don't know if you had a chance to see us ramble, but I said rates were likely to remain stable and that we wouldn't see any big moves ahead of the Fed meeting to come on May 3rd. There was no economic data this week that was really expected to move rates, and it looked like things were going to be pretty quiet for the week. And I said that we could see sentiment shift quickly. In other words, we have seen a path recently where markets were expecting the Fed would stop raising rates soon, the Fed funds rate, and that would kind of slow through the market. And I said that we were likely to see, that stay, but it could turn around very quickly. And let's go ahead and do a quick recap of what we did see last week. So rates improved in the middle of last week. That was right around the time we got the inflation data. So last week we got our CPI inflation data, and the good news is inflation is still cooling off. We call that disinflation. It is different than deflation. Disinflation is the slowing down of inflation. Deflation is when prices actually start to come backwards. And we know how difficult that is. Very few prices like to come back down. So we did find, though, that rates did improve the middle of last week. And, I've seen them kind of steadily rise since then, though. As an average, I would say that if you got a loan quote on last Wednesday and you got a loan quote for that same situation, the same credit score and the same down payment and the same home, you would see an interest rate that might be as much as 0.375% higher. It's been a pretty steady climb. James, have you seen an increase in interest rates from last week as well?
Yeah, so what's happened is, everything's kind of rolling along pretty calm. So how does this affect us? Well, there's this guy in St. Louis. His name is James Bulliard. He's the St. Louis federal president. And he comes out on the record and says, you know what? We still have some issues here. And he wants to raise the federal funds rate 75 basis points because he does not believe there's going to be a recession. So this 75 basis points, he thinks the labor is doing great, but what happens is how they kind of manipulate that data is there is this thing called seasonal adjustments for employment. Okay, so now all of a sudden we see this seasonal adjustment for employment. It makes employment look stronger than what it is. So now he wants to raise the rate 75 basis points, and the markets did not like that, and we saw a move in mortgage rates go up because of this guy's comments.
Absolutely. That was definitely a big part of that and the different Fed members that are speaking. And you're right. St. Louis Fed President James Bullard is known as a hawkish member. Not quite sure where they started with the birds, but when we talk about the Fed, we talk about doves and dovish, and we talk about hawks and hawkish. Dove meaning more accommodative as far as policy, generally looking to keep rates lower or to lower rates or quantitative easing. Anytime they're looking to stimulate the economy, we talk about a dovish outlook. When they're trying to slow things down and raise rates, and that's more of a hawkish outlook. And Bullard is probably the most hawkish of the hawks when we take a look at his different things. So let me throw my slides back up here and we'll keep going on that. So we have seen rates move up. Markets are now anticipating the Fed will raise its rates in May and possibly in June. So this ties along with what you just said, James. And again, I've shown this chart for y'all before, and I want to show it again. I know charts are a little bit confusing. This one's actually real easy, though. Right now, the Fed funds rate is at 4.75. The Fed funds rate, or as we just call it, the Fed's rate, is basically the starting point for a lot of the other rates in the economy. The Fed does not set mortgage rates, but they do influence mortgage rates by adjusting their rate called the Fed funds rate and the Fed rate. So right now, expectations, the rate is currently 4.75. If you add 3.25 to that, that's generally what you guys will hear is the prime rate when you look at home equity lines of credit or other kinds of loans. If they talk about prime, it's usually 3.25 above the Fed's rate. So prime right now would be about 8%. And the expectation is that in May, in a couple of weeks at the May 3rd meeting, the Fed is going to raise that rate to 5%. So there's an 83% probability right now. Markets currently betting the Fed is going to raise rates to 5%. Now, that's not news. We expected at least one more rate hike this year for the last couple of weeks. However, what has changed is we see that now there's an expectation that maybe in June, we could see a rate hike following this one. So right now there's about a 30% probability, whereas just a few weeks ago, if I show you this, where I'm going to click on this little compare button, and you guys will see that this was a month ago. This was actually an expected rate of about 4.5. So we went from believing the Fed would have to cut rates to now where we believe the Fed is either going to keep them at 5 or possibly raise them. And the dark lines here are the ones that show where we're currently at. And the lighter that these bar lines get, that's farther in the past. So a month ago, we were looking at possibilities of 4.25, maybe 4.5. Now we're looking at 5.25 or 5. So that's why we've seen mortgage rates that are much higher now than they were a month ago, is because of that. And the big thing that changed, James, I bet do you remember what happened or what was still happening a month ago and why, markets were believing the Fed might have to cut rates?
Well, outside of all this inflationary pressure?
Right, with the banks.
Because of the bank failure, because of what happened with the bank out west, the Silicon Valley Bank. And so that
Silicon Valley Bank and Signature Bank.
Nervous, because now it's like, is this a repeat of 2008? And so now that made the markets super nervous as far as that goes. And they wanted the Fed to get involved and maybe do something like a quantitative easing 4.0 version or something of those natures. I wasn't sure, but right now things kind of calmed down in that space. And I think everything is stabilized a little bit, other than, there are some Fed presidents, like some of the people out there in the market say that they are driving down the interstate looking in the rear view mirror, which is dangerous. We need to look where we're going, not where we were. And that part is a little bit dangerous. And that's a little bit what I'm concerned about with some of these guys like Bullard, is how he thinks, in my opinion. So.
Yeah, he wants to kill a cockroach by driving over it with his car. So he little too heavy-handed on how they're looking to solve this. So, but that's what you guys are seeing, is that a month ago we had a lot of the Chicken Little sky is falling concerns about the bank quote unquote failures, and the expectation that it was caused because the Fed had driven rates up as quickly as they have, as by raising rates as often as they have over the last year, and now that is starting to fade away. So markets don't expect the Fed to cut its rate as early or often in 2023, and that supports higher mortgage rates. And that's why the rates that you're seeing now, and generally VA rates, I'm going to say they're now averaging the low 6s. Conventional rates, if you don't get a VA loan for some reason, conventional rates are averaging high 6s into the low 7s, depending on credit score, the amount of money that you have to put down, different things like that. And this is for primary residences, of course, not for second homes or investment properties. But when we compare these rates, you are going to find a better VA rate to a conventional rate. And these are what if you're getting quoted somewhere in this vicinity, then you're probably pretty close. So if you were getting quoted a VA rate in the 7s, I'd be worried about that. If you're getting quoted a VA rate in the 4s, I'd certainly be worried about that. But anything that's in the low sixes, you're pretty much on par. Anything in the high sixes to low sevens for a conventional loan,
Also, Hammer,
you're pretty much.
those people that are getting quotes, make sure you watch out for some of the sneakiness. I had a veteran in my office, and he got a quote with the rate that started with a 4, and I said, "It's just impossible." But then he didn't know in the fine print that he was paying tens of thousands of dollars in discount that not was disclosed. It was on the paper, but the loan officer never told him verbally. So he's like, I said, "Don't sign that. Let me just review it." All right. So just be careful. If it's too good to be true, it usually is.
Yeah, and there's a lot that we can do to make things confusing. So, of course, if you have any questions, if you ever have any of the documents and you want them reviewed, that's what Vetted VA is here for, to help you guys. There's no reason you can't share that information and ask for opinions. You've got plenty of moderators that'll look out for you and give you sound advice and point you in the right direction on where to look to make sure that you get all that stuff taken care of. So looking at where we think rates are going to move from here, because everyone always wants to know, what are rates going to do? Well, unfortunately, I think rates could continue to creep higher from here. We've got the right economic conditions. And when we forecast rates, it's like forecasting the weather. Right now, based on the current conditions, we're looking at a situation that rates could continue to creep higher, and hopefully not too much higher, but at least a little bit higher. We're not likely to see any big moves ahead of the Fed meeting on May 3rd, but I was looking to that meeting to see some signs that the Fed would maybe signal to the markets that they were, done raising rates, rather than what, you were just talking about, James, someone like Bullard who said, "Hey, I think we should raise rates, even higher." It was likely that at that meeting, we might have gotten some help, but the chances of getting help from that meeting, everybody, is starting to really fade away. We're seeing that when I show you guys this chart, expectations are that the Fed rate is going to be much higher at the end of the year than what markets were pricing in just a few weeks ago. Now looking at maybe 4.5 or 4.75, whereas they were looking in the high 3s or low 4s. So that expectation shows that we're not likely to get too much help from this meeting. We need to see signs of economic weakness. We need to see reports showing that consumers are not spending money, that we're no longer seeing inflation, or inflation's continuing to go down very quickly. We need to see the labor market start to slow down. We need to see wages to stop growing. Unfortunately, we need to see things like people lose their jobs in order to see that the Fed has slowed down the economy. So we need to see all this risk of recession before we really see rates take a drop from. James, anything you would add about that?
Yeah, I would, because what we're seeing right now is, so just year over year, right, from a year ago today. Not even talk 2 years when rates were, in the 2s and the 3s, but just a year over year, rates are about 1.5 points higher in just 1 year. So the economy is still in a crazy situation where you see this real estate thing, the inventory is still too low. So there's not enough houses for sale for the demand. So they raise the price of the money, and that helped filter some people out. Purchases are down 36%. So if 100 people are buying, now only 64 people are buying. But out of those 64 people buying, there's still only like 50 houses for sale. Yeah. So now you have the still low supply, you still have a decent demand, and there are people still willing to pay the higher interest rate, which is still keeping prices very stable in the real estate sector for the most part.
Yeah, and also on top of that, the reason for the inventory issue, I explained this. I just recently visited my sister and her husband this past weekend in Pittsburgh, and we were talking about housing. And I said, basically think of it like this: in a normal market, right? Somebody in my sister's situation, she's got a 5-year-old and a 1-year-old, soon to be 2-year-old, right? So she's got 2 kids. The 2 daughters share a room. And I say, there was a time you were in this house, you bought the house, and maybe just fake numbers, but maybe you paid $200,000 and your mortgage payment's $1,000 a month, right? And you would say, hey, well, we've got the new baby and, we'd like a little more room. Maybe we want to go over to this other neighborhood because, our other daughter is coming of school age and we want to be over in that school district. So you would look to move to this other house. We call you a move-up buyer. And move-up buyers, you would go from this house that you paid $200,000, maybe your next house is $300,000, and you can afford a mortgage payment that's $1,200 or $1,300 a month. Well, the problem is when you bought that $200,000 house a couple of years ago, and you have an interest rate of 2.5 or even 3%, well, you're not just jumping price points, you're jumping interest rates. You're doubling the interest rate. So that payment, instead of going from 1,000 to 1,200 or 1,300, something that you could afford and kind of move with, well, now that payment might be 17 or 18. Again, these are made up numbers, but just for the illustration, now that payment is 17 or 1,800. So you say, you know what? I don't want to double my payment or close to double my payment. I'm going to stay in this house. We're going to let them share rooms for another year. And, our other daughter, she's only going to kindergarten. How bad can kindergarten be in the school district? We're going to stay here. And that's what's happening in the markets. So people can't afford to or are choosing not to move. And we're not seeing the normal flow of property. We don't see empty nesters moving out of houses and people moving into houses. And we're not seeing that natural ebb and flow to housing. And that's what people have to realize. And that's not going to change anytime soon until, what do you think could change that, James? So I'm going to let you take a stab at it and then I'll give my opinion.
Well, I think what's going to have to happen, and don't throw eggs at me, but if the country goes into a recession, officially a recession, historically and statistically, that will drive the interest rates down.
Yeah.
So even though
the other thing,
for the country, it's good for mortgage rates and real estate.
And the other thing, very much the same way. Unfortunately, we're kind of predatory in the mortgage business. And I don't mean that we prey on you for rates like people think it's, but in other words, we tend to do well when the rest of the economy does poorly, when people lose their jobs. The job market is a big, big component of housing because, people, when you have equity in your property, you can refinance. As long as you have a job, you've got a shot at refinancing, being able to pull out some of that equity or maybe get an equity line of credit or a second, an equity loan on your property. And that gives you some more money to kind of keep paying the bills. Well, the problem is if you don't have a job, if you lose your job, there's no way to refinance because nobody wants to lend you money if they don't see you having a source of paying it back. So then that puts you in a position where maybe you have to sell your house. And then what happens is more people have to sell their homes. There's more homes on the market. That's when home prices can come down a little bit. Now, do you think home prices are going to drop like they did in 2008, though? And why or why not?
Absolutely not. And the reason is 2008 was way different. If you look at the data, we don't have time to get it right now, but just the new build starts alone. If you look at what the new build starts with the last 10 years compared to prior to that, that's the number one reason we're having problems right now. After the Great Recession, they put a lot of builders out of business. Everyone was freaked out. And then through COVID, the cost of goods, the supplies, all that stuff was exorbitant amount of money. And there's still just not enough inventory for people who want to buy, even if they want to buy at 7%. The cost of money has doubled in a short period of time. But that still does not change the fact that our soldiers who are in Japan, Germany, that are getting PCS stateside, want to buy a house for their family. That is harder on our soldiers than it is for the civilian who's like, hey, we're just going to stay right. We're not going to move.
Yeah.
We're staying. Just what you said, the whole kindergarten example was perfect, Helmer.
Yeah. Thank you. So everybody, that's basically where we're at right now. Now, I'll tell you, the one thing I think has prolonged our inflation situation and, basically helped stimulate the economy and keep the economy going despite all these Fed rate hikes. I'm going to share my screen, James. I'll show you. There's a couple of articles that really bring this to light. The first one is right here. More U.S. consumers are falling behind on payments. Yeah. So what I've been saying for quite a while now is that people are spending money that they don't have. We're falling into credit card debt. We're,
Hammer,
spending
can I talk
money.
About that a second?
Yeah, go ahead.
Part of the reason is the cost of money is more than doubled. So the car payment that you bought 3 years ago might be $400 a month. Now it's $700 a month. The groceries you bought were $200 at the checkout line. Now they're $280 a month. The credit card interest rate might have been 4%, and now it's 14%. And all that is eating away at every civilian or every soldier or any citizen of America. The cost of money is crushing our economy right now.
Right. But and I agree with all of that, James. But what I am really talking about here is I may not have $500 for those groceries, but like this is actually a situation here. Americans go deeper into debt as they use buy now, pay later apps for groceries. So we used to call that layaway, and people are actually able right now to buy groceries and get the groceries today. But what they're doing is it's the old, Popeye, Blimpie situation, or not Blimpie.
Right. Yeah.
Who was he? He said, I'll gladly pay you Tuesday for a hamburger today. Right.
Right.
And that's what's going on is that people are they are spending money they don't have, but we can only do that for so long, and it's time to pay the piper, and that's what's starting to happen now. So as we see, unfortunately, and again, we're very empathetic to everyone's situation. We get this. It's easy to judge and say, well, people shouldn't be spending money they don't have, but sometimes they're spending money they don't have on necessities like gas or
Right.
food
Food for their
or
kids. Right.
yeah, clothes for their kids. It's not always just for that new iPhone 14. So what happens is people have been putting that on debt, and now that debt is becoming too burdensome and it's too much to carry. And what happened though is as they've been able to buy, that keeps consumer spending going, keeps the economy going. But now that it's time to pay the piper and that we're starting to see problems with the debt, and that also it's harder to get some of this money. Before, it was very easy to get money, Now banks have started to tighten up their lending processes on consumer and business loans. So all of this slowing down that flow of money into the economy. Now is when we're going to really see the economy start to put on the brakes. At least that's what looks likely here. Do you think that? I mean, that's what I'm seeing with this. What do you think, James?
Statistically and historically, you're spot on, Hammer, because as they raise the cost of money, when you need money, anyone will give it. When you don't need money, everyone will give it to you. When you don't need money, that's when everyone gives it to you. But when you need money, no one wants to give it to you. And right now, I said that backwards the first time, but right now you have all these people that need money. They tighten the credit policies because the cost of funds is so high. So there's a lot more risk, a lot more exposure. That hits the American, John Q. public very hard. So now they're buying for stuff that they need today. They can't afford it today, and that spirals out of control. Then you're going to see a bunch of defaults come our way. It's going to be a mess. I just want to encourage people, if you are struggling financially, look into your local community, food banks, grant money, any type of assistance to help yourself. But the fine print on that stuff, Hammer, the interest rates are exorbitant on that, and it just starts to spiral and multiply out of control, and you get yourself in a bad position.
Yep, absolutely. So, all right, well, we're coming near the end of our time. I'm going to go ahead and throw our forecast up there on the screen. This is my forecast. I think in the next couple of weeks, if you're currently under contract and you have a home and you said, hey, I haven't locked in my interest rate yet. Do you think I should lock in? Locking in, is when you actually lock that actual rate, meaning you can't see rates go higher or lower, then we could see rates creep up from here. And that's kind of, again, just a forecast based on the current conditions. So you may want to talk to your mortgage professional about the benefits of locking in. Over the next few weeks, I think rates are going to cap out, and then they'll fall again once we see some economic weakness. Now, when I say fall, I'm talking about going from those, high sixes in the conventional arena and low sixes in the VA arena to maybe the mid or lower sixes for conventional and back into the high fives for VA. We're not expecting big rate drops, but we will see rates pull back a little bit, maybe match where we were the last couple of weeks with some of the better rates. Longer term, rates are going to fall once we see real signs of the coming recession, when we see an economic slowdown, when we see labor market weakening and falling inflation. So, but that's really a question of when, not if. But the when, and that could be September, it could be December, and it really, you don't want to bank on that. But if your question is, why should I buy a home now when rates are higher? Look at buying a home today. The benefits, we've talked about this before, about why it's a good time to buy a home and the fact that you can always look to refinance later. James, what about you? What is your rate forecast? What do you think is going to happen with rates over the next couple of whenever?
So we're going to see rates creep up. And then I think what's going to end up happening is you're going to see a major adjustment going in the fourth quarter. So right now, real estate is still strong. It's a very strong sector. So I would encourage people, there's nothing like buying a house. All right. So I would say maybe rates are a little bit higher, but historically, the cost of money is still within reason. It's not double-digit mortgages. So the beauty of the VA loan is if there is a change in the market, you have the ability to do a super cheap loan called an IRRL, interest rate reduction loan. So what happens now is it allows the veteran to drop that rate significantly, save them some money. So don't be too freaked out. If you find the house you like and you can afford it, don't get too focused on the rate. Focus more, can I afford this in my monthly budget? And when the rates do adjust, I'll take advantage of it at that time. You have extra cash flow.
Very good. So, and again, that's something that's really a wonderful benefit of the VA program is that, Earl. So keep that in mind, that you'll have that opportunity to at least, check into doing that. So, all right, y'all, if you have any questions that we didn't answer today, please go ahead, post them. Remember, you can tag James Mercado. He is a vetted VA moderator. He'd be glad to help chase down those answers for you and show you where to get those. Of course, y'all can tag me. I'm Hammer J. Helmer, and I'll see you next week. Thanks again for joining us, James.
Yeah, thank you.